one thing that I have found, as a financial advisor is that trust comes into it a lot. The main goal of a financial advisor really comes before any of that. Super insurance, it's basically me helping my client achieve their financial goal, whatever that may be. For some people, it might be, look, we want to retire by the time we're 55 and we want to earn $100,000 a year in retirement, or it might be something as simple as we want to buy a new car, or we want our kids to go to this particular school. Then it's up to me to say to them, okay, well, this is where you are now. And to get to that point, this is what I would recommend you do. Obviously, the earlier you start, the easier it is to achieve your goal.
Good day everyone, and thanks for joining me in another episode of the Mortgage Chat. Today, I have a very special guest. Name is Andrew Schroder, who is in the pinnacle of his financial planning game, and I'll welcome him joining in our podcast today. Thanks for joining me today, Andrew. So just so our audience know a bit about you, can you tell us, what do you do in your profession, how long you've been doing it for, what you specialize in?
Sure. Well, my name's Andrew Schroder. I am a financial advisor. I have been doing it now. Well, I've been in the industry since August 2001.
Yeah.
So, wow.
How old were you then?
Oh, geez. I would have been just 20.
Yeah.
Jeez, and now I'm 42. So, yeah, over 20 years of experience, but it goes fast.
Yeah.
Yeah. I tend to specialize in, superannuation, personal insurance for clients. I tend to steer away from, self-managed super funds and anything a bit too complicated. My theory is, you can't be everything to everyone. So I tend to just stick to sort of what I know, what I'm good at, I think, and leave the more complicated stuff to other people. Most of my clients are your typical mum and dad clients. So they're not complicated people themselves, and they're not looking for anything, too crazy. It's more about just getting through that part of their life where they're raising children and setting themselves up for the future.
Yeah. So as a financial planner, you can do a big broad of things, right? But you just want to stick to the 1-2 things that you can become a specialist in.
Yeah. Look, I've got clients also in the retirement phase. So I do deal with things like, Centrelink and investments outside of superannuation. But I would say probably 60-70% is just as I said, your typical mum and dad clients, looking after the superannuation, make sure it's invested properly, and just ensuring their position as well, so that if something happens to either of them, all the cards don't fall down, so to say.
Yeah, and a lot of people don't think about that, do they? Especially if they're holding a bit of debt.
Exactly. Like, everyone will insure their car, their home, but people tend to not think about ensuring the thing that's most important to them, which is usually their income or their property, or ensuring their debt so that if something happens to them, they don't need to run off and sell the place or put themselves in a position that they don't want to be. I think that's and I think it comes down to a lot of people thinking, that'll never happen to me. That's that type of situation. Everyone's living their life, and they don't think that an illness is going to strike them down, or they're going to get into a car accident and they're not going to be able to work for 6 months. Myself personally, I've been through something like that that's taken away from my ability to work at 100%. So I know firsthand the importance of having insurance or protecting yourself if something were to happen. Yeah. I like to, I guess, bring that to my clients' attentions because, as I say, a lot of the time I don't think they realize, and I think that's also part of a financial advisor's job, is to point out gaps in someone's situation where they might not think, that they need to address. Yeah.
So you've been a financial planner. I mean, you worked in the industry since 2001.
Yep.
A lot's changed since then?
A lot's changed. I always remember I started in August 2001, and so I'm just to give you a bit of background, I came out of school in 98. I had no idea what I wanted to do. I was lucky enough to get a job with the ANZ Bank, just working in their back office department, just doing paperwork. Yep. But at that time, it was really just I was working to make money, so I could go out on the weekend. I had no
to the fiddler or.
Well, back then it was the TAV, Castle TAV. But because I worked in the city, I was going out in the city on a Friday and a Saturday. So at that point, I had no idea what I wanted to do career-wise. And then So I worked with ANZ from 98 to, probably mid 2001.
Mm-hmm.
And my uncle calls me one day and says, why don't you come work for me?
Mm-hmm.
And I was like, well, I don't even know what you do.
Yep.
He says, well, come have a chat with me. He was working in Bondi Junction and he was a financial advisor.
Mm-hmm.
So he had his son had just finished school at that time, my cousin. So he started working for the business. So I think he wanted to also bring me on, so to have that sort of family business. So again, at the time, it was really just a case of, okay, this sounds cool. I'll be working with my cousin.
Mm-hmm.
We're similar in age.
Yeah.
I'll be working with my uncle. Sounds all cool. Again, I didn't even think about I wanted to be a financial advisor.
Make a bit of money, spend it.
That's all. That's all it was at that time for me.
Yeah.
And then, so I started in August 2001, and as we all know, September 11 happened 1 month in, and I quickly found out how these type of world events affect not only clients, but the markets and the value of everything. So I quickly got a crash course into, how it all sort of intertwined.
Yep.
From there, I just learnt it from the bottom up, so to say.
Yep.
In 2005, I got my official qualification to be a financial advisor. And then slowly my uncle joined businesses with another advisor who was retiring. So I took on some of the other advisors' clients because they were based out in like Parramatta region. And I live out in the northwest myself. So I quickly then just sort of had my own little group of clients that I got to know. They got to know me. And I think one thing that I have found, as a financial advisor is that trust comes into it a lot. There were numerous times along the way where I would sit in an appointment with my uncle, just to take file notes and just observe how it all works. And the number of times a client would say, yes, Michael, my uncle, whatever you say. They just didn't care to understand how it all worked. They didn't care about the mumbo jumbo. They were just like, yeah, we trust what you say.
Yep.
So that was really like eye-opening. And I know I've had that happen to me a couple of times, over the years where I'm trying to explain the strategy and go into the ins and outs of it. And they're like, we don't care.
Does it annoy you sometimes that they don't want to know?
It does and it doesn't. It does because I'm into it and I'm trying to explain it.
Yeah.
And I feel like I've come up with this really good way to explain it and make it simple.
Yeah.
And then they just come back and say, yeah, look, we don't care. We trust you. But that's also an amazing thing as well, to know that someone will just trust you with their livelihood, really. Hundreds of thousands of dollars, retirement. And it also makes me quickly realize, how many people have actually been done bad by advisors too, probably for that reason. Yeah. So it does put you in a very, I guess, important position to look after these people as well, especially with clients getting older as well. I've got a few select clients that are now looking at an aged care situation, and they're asking my opinion, not just on what to do with money, but what do you think of this place? I've had a couple of clients that wanted me to be their power of attorney, and it's just like, wow, it's like for someone to trust you that much ahead of family, to do that, it's quite humbling, I guess. Is the word I was looking for.
And the financial plan industry has changed a fair bit, the last few years as well. When I started working in corporate in Colonial First State.
Okay, yeah.
Back in I'm trying to think now. Back in 2010, 11, in back office.
Yep.
And we saw the Storm Financial. That stuff happened. That killed the financial planning a little bit. All right. And I think it was probably about 4 or 5 years ago where financial planners need to have a degree qualification now to operate. Yep. Right. So can you explain to us a bit more what was the reasoning in behind, hey, why does a financial planner now has to be degree qualified? Why they didn't for a very long time?
Well, that's actually a question that a lot of financial advisors want to know as well. And what they've actually done is they brought in these new rules saying that, an advisor has to have a degree or the equivalent, especially for new advisors coming into the industry. But then they also brought in measures for existing advisors in the industry who didn't have a degree, sort of like a pathway on how to get there. Now that's actually just recently changed as well. They've brought in this, not sure the exact wording of it, but basically if you've had experience in the industry for a certain amount of time, then they'll basically waive that requirement. And myself, like I don't have a degree level, like I've got an advanced diploma. So if I wanted to continue, or if I was good to enter the industry now, I'd need to do this, 8 unit course just to join the industry.
Yep.
And that actually led me a couple of years ago to question whether or not I wanted to stay in the industry. Because like I'm only 42, so I was just before I turned 40, I guess. I was still quite young in my working life. And I had to decide, look, do I want to go back to basically university and do all this training for something that I already know how to do? Now, luckily, for me at least, because I hadn't made that decision until they had decided on the official rules that they were going to bring in. And they just finalized it in the last couple of months where I actually meet that qualification that I've been in the industry for more than 10 years, so that I don't need to get the degree to stay in the industry. So I was quite happy about that. That sort of took a lot of weight off my shoulders,
100%.
or don't need to worry about doing it. But in saying that, we still have to do ongoing training. And, if I decided I wanted to give advice on self-managed super funds, then I just can't go and do it. I have to be accredited in it. So I would have to go and do training for that. So I feel like I'm qualified or even overqualified for the advice that I actually give.
Because your experience, right?
Exactly.
Your experience.
And a lot of what I learned, as I said, when I first started in the industry, was just learning it from the ground up. Sure, I was learning it in terms of how my uncle wanted to teach me. So he had his own, skewer on things. But I think I've taken 90% of what he's taught me, which is a good foundation, and added my own little twist on it, or I don't do the things that he would do. So
because I still remember back when I was in CBA, I think it was what's called the RG146 or something.
There's been that many iterations of it. I wouldn't even. Yeah, I do remember those letters and numbers. Yep.
I do remember. That's all you need to have to be a financial planner at CBA.
Yeah,
that was all it was. That's all it was.
And I guess that's where a lot of the, especially when they did the Royal Commission into everything, that was one of the things they wanted to address, was the education. It's something so simple, like a piece of paper or a short course, just to be able to give all that advice. I think that was a good thing that changed, but I think it's a bit of overkill with what they were trying to do about having a whole degree to get into the industry.
And that's the same thing as being a mortgage broker as well, right?
Yeah, it's going down that road as well.
It's going down that road as well. So I think there is some sort of regulation that needs to be in place, to shift a lot of the cowboys.
And the problem is, I think with the regulation, the regulation always gets over-regulated, especially the more, like, I used to hear stories of when I first started in the industry, my uncle was dealing with companies that would basically say, look, you place your business with us, and it'll go towards you getting a conference going to Alaska on a cruise. So I kind of, in a way, I kind of joined at the wrong time. Didn't get to benefit from any of those conferences or junkets, as they call them. But it's crazy when you look back, I think what they were getting away with in a sense that.
Bit of conflict of interest, wasn't it?
It was. Because I remember my uncle spoke to my stepdad once, said, look, if we put your business here, it's still in your best interest to do so. You're not going to be any worse off. But by doing that, I'm going to qualify to go on a conference overseas. It's like, well, and I think it made advice more about product as opposed to strategy. And I think that's, if anything, that's the one good thing that's come out of these changes that they've made, that it's more advice and strategy focused now as opposed to just product. Because that is also part of what a financial advisor does, is not only am I talking about a specific strategy, but I'm also talking about a particular product that would help them achieve what the goal is.
So do financial planners have access to different products like a mortgage broker will?
Yeah, so through my dealer group, who's Millennium 3 Financial Services, so they're basically the people who I'm licensed through, and they make sure I do my job properly.
In compliance.
Yeah, I get audited on what used to be an annual basis, but that's changed. It's now like a monthly thing. But they basically make sure that I do my job properly. As part of the dealer group, they have what they call an approved products list.
Yep.
So they've got their own team who researches all these products and, what it offers and the fees and all that type of stuff. And they sort of narrow it down for the advisors that are licensed through them. So just say that there's, for argument's sake, 500 super funds out there. They might have an approved product list of around 30.
Yep.
So before you even start, you know that you've got to work with these 30. Now, you can still recommend a super fund that's not on the approved product list for whatever reason. You just have to have a reason for doing it. So you might have a client that's already in ABC super fund.
Yep.
That's not on your approved product list, but you can say, look, based on our conversations, your goals, I think it's best that you stay where you are for these reasons. And you just have to get permission to recommend that fund. So you can't just go out and pick one, willy-nilly, so to say.
Yep.
There's an approved product list that's had its research done on it, and then it's up to the advisor to choose the most suitable product for the client and back it up with reasons why.
Yeah. Are certain financial planners aligned to certain products only?
Yes, I guess you've got financial advisors that are, employed by the banks.
Yep.
So you might have one through Commonwealth Bank. So they'll recommend any products sort of aligned to them. And the same for the other banks, ANZ, etc.
So there's no difference to a mortgage broker where, hey, do you know what? You go to a mortgage broker, you get 30, 40 products in front of you, but you go to a banker, you get one product in front of you. Is that similar?
It's exactly. That's the perfect comparison. Myself as an advisor through Millennium 3, I guess I don't have to recommend any particular product other than being on the approved product list, but that's more for research and knowing that the product that we're recommending to the client is, out of the 500 super funds out there, these are sort of your best researched ones. So I don't have to recommend any particular products. I can recommend whatever is in the client's best interests, which is what we have to do at the end of the day.
So what is actually the main role of a financial planner? So you told me that you deal with insurances, you deal with superannuation.
Yep.
Let's just move insurance out of the way for a second and let's talk about this superannuation.
Sure.
Okay. What is the main purpose or the main goal of a financial planner that's dealing with superannuation?
The main goal of a financial advisor really comes before any of that. Super insurance, it's basically me helping my client achieve their financial goal, whatever that may be. For some people, it might be, look, we want to retire by the time we're 55 and we want to earn $100,000 a year in retirement. Or it might be something as simple as we want to buy a new car or we want our kids to go to this particular school. Then it's up to me to say to them, okay, well, this is where you are now. And to get to that point, this is what I would recommend you do. Now, in terms of superannuation, that's mainly seen as, a savings account for retirement. So I always have clients ask me, how much do I need to retire on? I said, well, that's, how long's a piece of string?
Yep.
How much, what do you want in retirement? One, do you have an age in mind where you'd like to retire? Some people don't even think about that. And to be honest, I haven't even really thought about that myself.
Yep.
Maybe being self-employed and you just get caught up with, having to do everything yourself. I haven't really sat down and said, you know what, I want to retire when
You're ready.
60.
Yeah.
I just,
Because
hasn't crossed my mind.
Because someone that's a concreter or bricklayer might want to retire earlier in comparison to a management role in a bank, professional services. We can go up to 70, 75, 80.
Yep. So I say to clients, I say, look, you've got two things. Do you have an age in mind where you thought you might like to retire? What are your plans at retirement in terms of, most people say, look, I want to get out of Sydney. I want to move up the coast, quite a lifestyle. How much would you like to earn as an income in retirement? Once we know those things, we can sort of work backwards from there. And as I said, we can say, look, this is where you are. You've said you want to earn $100,000 in retirement. At that time, you probably will move. So this is what you would need to do to get to that, to meet that goal. It's a constant evolving thing, especially with the different strategies available. that can change from year to year depending on the client's age and whatever the government decides in their infinite wisdom to change all the time. It's always a constantly changing environment.
Yeah.
So that's why reviewing thing is also important as well. So it's not just a set and forget strategy. It's a, look, this is what we can do now to put you in a better position. But also going forward, if we meet up, next year, has anything significant changed? Oh yeah, we've just found out we're pregnant. We're going to be having another kid. Okay, well that's going to change things.
Yeah.
So let's tweak things, or this is what we might need to change. So yeah, it's a constantly evolving thing, and something that needs to be reviewed on a regular basis.
Yeah. So Andrew, for anyone that holds debt, right? Doesn't matter if it's going to be owner-occupied debt, investment debt. You geared yourself marginalized in stock purchase or stock investment, whatever you want to call it, debt in general. How important is having insurances in place? I say this because a lot of people believe the insurances that hold in place in the superannuation is substantial enough, which you and me both know that is not substantial enough.
Correct.
Can you explain that a bit more to the audience?
Yeah, well, look, the whole purpose of insurance is to protect your financial position. So for argument's sake, I think you used the example of, just say you had $2 million in debt. Now, if you didn't have the appropriate insurance, you have to ask yourself what would happen in the event of your death. So say you've got a wife and 2 kids, what happens then? Can your wife service the loan? Is she working? Most likely with the debt that high, it would be a dual income, working to pay it off. Would you want to leave your wife and 2 kids with that level of debt, unable to servicing it, which most likely would mean they would have to sell the home? It just puts them in a dire financial position. So not only does it protect the asset that you have, it also allows the surviving spouse to pay off the debt, essentially be debt-free and in a better position going forward. It's also a peace of mind thing. Now, obviously, you're not going to be here because you're dead, but you'll know that your family will be looked after. In terms of the insurance that someone would have in their super fund, we're talking about, default amounts. It's usually unit-based, and it usually varies between 50 to 200,000 for life insurance.
Okay.
So if you don't look at your situation and you have, again, $2 million in debt and you pass away, your family gets 200,000, best case scenario, what's that going to do? It's not even going to put a big dent in the loan.
When you get additional insurances, is okay, well, my debt's 200.
Yep.
My super is going to cover up to 200 grand.
Yep.
So I need to get additional insurances to cover the remainder of the 1.8.
Yes.
Yeah.
So there's basically in its simplest form, yeah. Now there's various ways to do that. There's multiple ways to structure insurance, and it really comes down to, for an individual, it's to their individual circumstance. So most of the time, it makes sense to fund your life insurance from your super fund. One, it's tax effective. Most people are using their after-tax dollars to pay down their loan anyway. So in most cases, again, it's depending on an individual circumstances, but most of the time, people would fund their life insurance through their super fund. Now, you've also got what they call TPD insurance. Now, that stands for Total and Permanent Disablement. So, for example, you're in a car accident, you become a paraplegic, you're wheelchair bound, you're going to need substantial funds to not only look after yourself going forward, medical bills and that type of stuff, but also you want to also be in a position where you can probably pay down your debt as well, because you're not going to be able to work. And you need most of your funds, as I said, to look after medical expenses.
Now you're talking about income protection?
That's another insurance as well. So when we talk about personal insurance, you've got life insurance, TPD insurance, which we sort of just went through. You've also got income protection, as the name suggests, it protects your income. And I'll go into that a bit further. But you've also got what they call critical illness or trauma insurance. Now, I'll just come back to the income protection. So as the name suggests, it protects your income. Generally, you can insure yourself for up to 70% of what you earn. Now, the reason they have it at 70% is if they covered 100%, no one would want to go back to work.
Yep. Quick question: Is it assessed differently if you're a PAYG worker and if you're a self-employed worker?
Yes. So if you're a normal pay-as-you-go PAYG, it's really just what you're earning and your superannuation component on top as well. When you're self-employed, it becomes a combination. It's a bit of a formula, but at its simplest, it's a combination of what you're earning. So if you're drawing down a salary, plus any profit of the business. Mm-hmm. So even though you might be paying yourself $100,000 a year for ease of a situation.
I wish sometimes, but anyways. Yeah.
So if you were earning $100,000 a year, but your profit was $500,000, mm-hmm. you don't want to just insure yourself for what you're earning because your overall position is much better than that. Mm-hmm. So you can also insure yourself for the profit of the business. So it gets a bit more complicated when you are self-employed in terms of, when you go through the whole application process, you have to provide financials and stuff like that. But that's getting into the weeds, as I say.
Yeah, too much.
With income protection, you've also got what they call a waiting period
mm-hmm.
and a benefit period. So the waiting period is how long you have to be off work before you can make a claim. Okay. So the standard is usually 30 days.
Okay.
And that's usually because most people have, up to 4 weeks of sick leave or annual leave that they can use mm-hmm. in the interim. So if you're on an extended, just say you break your leg and you're off work for 2 months. Mm-hmm. You would be off work for that first month. You'd use your sick leave, your annual leave,
yep.
and then you'd be able to claim on your income protection policy. Mm-hmm. Now, you've also got what they call a benefit period, and that's how long they will pay the benefit for. Mm-hmm. There's multiple options that you can choose, which will affect how much the policy costs. Obviously, the longer that a benefit would need to be paid for, mm-hmm. the more expensive it would be. That's more for if you're in this situation where you could never work again. The standard benefit period is usually to age 65. Mm-hmm. There's also now ones that are to age 70 because people are working longer.
Yep.
But you've also got benefit periods of 1, 2, and 5 years, mm-hmm. like short-term policies. So depending on a client's situation, again, there's different ways to structure income protection insurance. You can have income protection insurance in your super fund, but it tends to be more of a basic policy. Or you can have your income protection outside of superannuation, and that tends to be more of a bells and whistles policy mm-hmm. with many more things you can claim on in terms of partial benefits and stuff. Again, that's getting into the weeds a bit. Now, one thing that's sort of become more popular in the recent years is what they call a split structure.
Yep.
So you can actually structure part of it in your super fund mm-hmm. and part of it outside of your super fund. So that's good for cash flow reasons, but it's also giving you a bells and whistles policy, but with your super fund helping to pay for the cost.
Okay.
So that's income protection.
Because essentially, if you're saying the super can pay for your premiums, so you're saying I can salary sacrifice into my super.
Yep, that's a strategy.
Which
to do
reduces.
as well.
I can reduce, let's say, instead of paying 30%.
Yeah, so that it basically reduces the impact that having that premium coming out of your super fund. Because obviously, if you don't address that, it can have a drag effect on your balance, especially over the compounding factor over the years. Mm. With critical illness / trauma cover, that's a lump sum benefit as well, similar to TPD cover, but it covers you for things like, if you were to have a heart attack, stroke, cancer, the type of things that we're being sort of exposed to more and more. Mm-hmm. Like I know when I started in the industry, I didn't know anybody that had ever had cancer. Mm-hmm. But since, I've lost my dad to cancer. Mm-hmm. I've had multiple clients that have gone through claims. Mm-hmm. So it is a thing that more and more people are going through, but they're surviving now with the medical technology. They're actually surviving and they're actually returning to work. Mm-hmm. So it's more of a short-term benefit to help with the expensive costs that come or are associated with going through a trauma. It gives you the option you can choose what doctor you want to see. You don't have to just rely on a doctor that's chosen for you.
Yep.
Having that sort of bit of an extra buffer of income come through can give you a lot more choices, and it takes off a lot of the pressure about having to worry about going back to work so quickly. You can actually, you know what, I don't have to go to work right away. I can take my time, recover, and return to work when you're ready.
Okay, fair enough. Something just popped up to my head when we're talking about, insuring myself for a certain amount. So let's say my debt was 2 mil and I insured myself for 2 mil.
Yep.
If anything happens. And I pay the premiums based on being covered for 2 mil.
Yep.
Okay. So let's say, for example, me and my wife are able to pay down 100,000 of our debts every year, for example. So what actually happens to the coverage? Because my debt level is only 1.9 now, but I'm insured for 2 mil.
Well, the short answer is nothing will happen to it if you don't review it on a regular basis. Okay. And that's all part of reviewing your financial position on a regular basis, because things change. As you said, people might pay their debt down at a quicker rate. And I've had the same situation with clients, especially when they factored things into their, because with their sum insured, it's not only, they've added in, look, okay, we'll be debt free, we'll pay off our debt, but we also want to factor in an amount there that, should one of us not be here, that we will still be able to send the kids to private school. So, you can factor in an amount to cover that. But as you progress with your clients, or as they get older, their situation changes. So I met with a client recently where our son's just gone to university. Okay, well, we don't necessarily need to factor in private school fees now to the sum insured. But at its simplest form, as your debt reduces, you can reduce your insurance cover as well. That's why you need to review things on a regular basis.
And it is your job to regulate on a yearly basis?
Yeah, look, with my clients, I like to meet with them at a minimum on an annual basis. I've got some clients who are a bit more, they like to meet more often, 6 months, or even 3 months. I've got a few clients. It's really just what they're comfortable with. But at a minimum, I'll touch base with my clients and say, look, it's been 12 months since we last spoke. Has been any significant changes to your circumstances?
It's very important, isn't it, to keep touch with your clients?
A lot of the time they'll say, look, no, just plodding along. Nothing's really different. Like I still offer to, look, do you want to catch up? Most of the time they'll say, and I think it's just human nature with working, they'll be like, oh, things are just too busy at the moment. And I'll give them a rundown of their position and look, this is how things have happened in the last 12 months. And if I see something that I think needs to be addressed, I'll say, look, I think we should catch up because of A, B, and C,
And the reason why I asked that is I had a financial planner back in, I think it's 2017, I think it was. I've probably got in contact with him once a year for the first 2 years. And after that, since today, I've never heard from him, right? So not saying all financial planners are like that, but sometimes you feel like, hey, some financial planners are just a bit of a cowboy out in the market.
Yeah, and
right? And they're probably listening to this podcast right now, right? Don't call me.
I was going to say, you're giving them a shout out.
Don't call me.
I think that used to be very prevalent back in the olden days, where a lot of advice around superannuation was commission based. Because you'd effectively, and this is before the regulations came in as well, you would effectively sign up a client, you charge your fee as a commission, and then it's really like for a lot of advisors, it was a set and forget. They're on the books. You're getting your commission. At the time, you don't have to really do anything else. There wasn't it's different these days. It's like more of a fee for service industry. And for me to charge a fee to a client, I have to meet a certain, like a checklist, like a criteria. If I'm going to charge you this fee, I need to provide these services for this fee.
As a minimum.
If I don't, then the fee can be, taken back. So I think that's changed that sort of with advisors who weren't getting in contact with their clients on a regular basis, because back then they didn't really have to. There was no disadvantage or rules saying that they had to. Whereas now it's much more regulated.
Okay. So what sort of misconception consumers out there have on the financial planning industry?
Well, I guess the first one is what we were sort of just talking about there, is about a commission based. It's not like that anymore. It used to be. but it moved away from a commission-based structure, I guess, to more of a fee for advice structure. And as I sort of said before, for me to charge a fee to a client now, I have to provide the service for that. I guess another misconception as well is probably more so about the insurance industry is, a lot of these direct insurance ads that you hear on TV or on the radio, without naming them any specific ones. I think people need to be careful about those because not everything is what you see with those. There's a reason it's called direct insurance, and there's a reason they'll hand out the insurance so willingly without the need for any what they call underwriting, which basically means an insurance company will ask you, financial and medical questions and base their decision on whether or not they want to cover you based on that. Because an insurance company, at the end of the day, is a company making money for their shareholders or wanting to make profit. So they're not going to insure someone who comes and says, "Oh, I've got a sore back. I haven't been to work for the past 12 months." They're not going to insure someone and cover them for a back injury if they know that the person has a back injury. That's just common sense. A lot of these direct insurance companies will just ask you the general questions and say, okay, you're now covered for $500,000. But when it comes to claim time, that's where a lot of people have a lot of trouble, because then they'll start asking questions. Well, you said you can't work now because of your back. Did you have a back injury 5 years ago? Oh, well, yeah. Well, it's a pre-existing condition, so we're not gonna pay. And I think that's where a lot of insurance companies get a bad rap, that they don't pay out. In my experience, and again, might come down to me using a select few insurers that are on my approved product list, but I think I've had 7 claims with clients and I've never had an issue. And I think that's due to, one, picking the right policy at the time, and also having it fully underwritten so that you're covered based on your current situation.
And making the checklist in place, right?
Exactly, yeah.
Questions, checklists, everything. No, agree. So in our field, we as a mortgage broker, in our field, we have a lot of investors that either invest in capital growth properties with smaller rental yields, or, the lower end properties with high rental yield for cash flow purposes. I'm a big believer that you should have a mixture of stocks and property in your portfolio. Can this be achieved in the stock market or in your example, superannuation, where you invest in stocks? Can this be achieved where, I can either chase the capital growth and not really care about the dividends being paid, or?
Well, the short answer is yes. I know we're probably all familiar these days around the concept of diversification and not putting all your eggs in one basket. And that's one of the things when I usually meet with a client and look at their super fund as a default super fund, you'll notice that they're only in one investment option.
What do you mean by default super fund?
Whatever super fund that they're basically in. So a lot of the time with their employer chooses a default super fund. Just say it's, again, ABC super fund, and they get put into a default investment option based on how old they are. It's usually like a balanced investment option, but that's not always the best investment option.
But you can change that yourself, can't you?
Yeah, and that's part of what I would recommend to a client. I say, look, based on what your goals are and your attitude towards risk, because some clients don't like to take risk. And I've always taken the approach, why take any more risk than you need to achieve your goal? Sure, it would be great to have, 15, 20, 30% returns every year, but it's not achievable. And that's why, a lot of people are jumping on the, in recent years, jumping on the Bitcoin and because they're seeing these massive returns, but it's just not, it's not sustainable.
So let's talk about sustainability, right? So now we're in the early stages of the second half of 2023. We've seen a big push uptrend in the S&P, right? ASX. Can you make a bit of comment about that? Because I personally think it's actually gone up too fast, right?
When you first said that, it reminded me of when I first was in the industry and I was going to these investment seminars with my uncle. And these were just about, what's the outlook for the financial year, Australian share market, and overseas, what's the trend, what's the outlook. And it was more just so I could learn about all these type of things, right? And I'll never forget, I went to 2 in the same week, and they were both about the Australian share market. And one person said, next 12 months, it's going to be great. Going to have plus 15% returns.
What year was this?
This was probably early 2000s.
Okay.
So anywhere between 2001 to, I think it was probably on the back of the recovery from September 11, right? So a couple of years after that. I went to another seminar in the same week, and the guy said, the next 12 months is going to be terrible. And I quickly said to myself at that time, I was like, it's like nobody knows what they're talking about.
Yeah.
It's like, it really is sometimes like a guess, or you wish you had a, what's that thing called? You wish you had a crystal ball so you could see what's actually, because one person's saying one thing, one person's saying the other, exact opposite.
Because that's commentary right now, what we're having, right? Are we going to have a soft landing and a recession, or hard landing? Like, what's going on? Stock market, it's going to crash. It's gone up too high.
Yeah.
Right?
Look, I think the conversations I've been having with my clients, it's all been around recently about the interest rate rises, inflation, and they've been putting a drag effect on markets, right? Now that I guess inflation is sort of somewhat stabilized, and and interest rate rises looks like we're at the peak, and there might be maybe one more or 2 more. Who knows? I think we're at that point now where the recovery will keep going. Whether or not it's too fast or too slow, I don't really.
When you say recovery, what do you mean by recovery?
Well, just from the downturn in the market from the inflation and the raised interest rates. I think because now we've sort of peaked, and it's going to start to come down again eventually, or be on hold. I think that puts more confidence in the consumer.
Because the stock market hasn't gone backwards too much.
No,
has it?
No,
I think in the last rate rises.
Yeah, I think in the last 12 months it was. I think I saw the other day I was up like maybe 9% or something. So, if you had been invested in just in Australian shares, you'd be quite happy with that, with everything else that's been going on. And I'm seeing the same trend now when I'm seeing clients and reporting on their 12-month returns. It's it's quite good.
They're banking, mate. They're banking.
Yeah. So it's more about a saying I learned early on was that it's more about time in the market as opposed to trying to time the market.
Yep.
Because you get a lot of people that'll trade on a daily basis and trying to pick trends, and that's all fine if you know what you're doing. But for the general, mum and dad, for lack of a better term, they don't know what they're doing, and they don't have the expertise to do that. And I'm not necessarily saying I have the expertise to do that on a daily trading basis, but that's why I like to focus on diversification with my clients and investing for the long term.
Yep.
And all you can base that on is what's happened in the past in terms of history. And I always explain to my clients that, and I'll show them a graph, from the last, 20, 30 years. And you'll see that there's ups and downs in the markets, but over the long term, there's the constant upward trend. And what you've just got to try and avoid is, as you get closer to retirement and again, it's part of reviewing your situation. If you're within 5 years of retirement, you don't necessarily want to be invested in an aggressive manner. Because if there is another drop in the market, another GFC, another COVID or whatever that crashes the market, you don't want to be taking that hit so close to retirement. You've seen multiple times where there'll be someone on like a current affair or something saying, we lost all our retirement savings. It's like, well, that's sad, but if you had a good financial advisor, you wouldn't be an investor like that so close to retirement.
Are you able to share a horror story where, someone that hasn't really invested or taken out an insurance policy or it's too late and they've gone to you for help?
No, I can't actually. But what I can share with you is the opposite of that. I had a client recently who was diagnosed with stage 4 cancer, and he actually wasn't even aware that he had the insurance policy, because it was like in terms of he was one of those clients who trusted what I had recommended for him.
Right.
He was a type of client where whenever I would meet with him for a review, I'd be like, look, this is what you have in your super. This is how it's performed. He's like, yeah, don't care. as long as it's not going backwards.
Yeah.
I would say, look, this is what I think we should do. Yeah, we'll do that. It's fine. I could have told him anything and he would do it, right? So yeah, he was diagnosed with stage 4 cancer, and he called me and told me, and I said, well, look, I'm pretty sure you have a trauma policy. Let me take a look. And he did. He had a trauma policy that I had recommended for him, which he was able to claim on, and he was able to have an influx of a lump sum of money that helped him not stress.
Yep.
Helped him focus on recovering, and helped him eventually return to work before he eventually succumbed to his illness. But it was things like that. And I remember when the claim was approved, he was just so thankful. He's like, you are, and he even said, he goes, I know I don't pay attention a lot of the time in our appointments, and I tell do whatever you want to do. He says, but what you've recommended for me has changed my life now, and will change my life when I eventually pass away, because he had a terminal illness.
Yep.
Because his family was left with sufficient funds to be debt free and to have the options going forward to live comfortably. So I don't necessarily have any horror stories. I've had a couple of clients when I've met with them for the first time who have told me of their experiences with other financial advisors, and that it's cost them a lot of money. And again, that goes to
a lot of money in what way? Losing out on the investments or the fees? What is it?
It was more the strategy that they were put in. I think a lot of advisors, well, scrap that. I don't think a lot of it. I think some advisors automatically will recommend their strategy no matter what.
So it's like what?
10 different clients, they'll recommend the same the same thing to 10 people.
Yeah, like a factory.
And for this client, it wasn't necessarily what was in their best interest. It was getting involved in a self-managed super fund and buying a property in it. And sure, that's a good strategy for some people, but for these clients, it wasn't. And because of what they went through with that, they lost a lot of money on when they tried to get out of it, because the property had just lost money. And anyway, so in terms of horror stories, I've had a couple of clients that are now my clients where I've heard of their experiences.
Yeah. And
then it makes me like, oh geez, I can't believe you would even trust another person to look after your finances.
Because funny how touched base on buying property with the SMSF, right? Because that was very big back 4 or 5 years ago, until all your major banks, mainstream lenders stopped it because it just wasn't sustainable. But it slowly caught to my attention where a lot of the financial planners were actually recommending SMSF, and they were actually selling or recommending these off-the-plan properties for them to purchase under SMSF because they were getting a big kickback from the developers.
And that's the conflict of interest.
Right. And I still remember I went to do a real estate agent course. That was back in 2018. It was 2018. We had one financial planner that was doing the real estate agent course because he had an in-house accounting, which his wife ran. He was doing the SMSF advising. He was doing the selling as well, and he needed a real estate agent license to sell the property. So he was doing all that in-house.
I had one advisor come to me and say, look, I want to do this for my client, self-managed super fund, whatever. Can you just put up a statement of advice just to sign off on it? And I'm like, no, why would I do that? One, I don't even know this client. And even if I did, I don't even know what you're doing is the right thing for them. So look, you're always going to get and this is an industry really, you're always going to get, a few bad apples, as I say, and they tarnish the rest of the industry.
Correct. You might have 8 people doing the right thing, but all you need is just 1 or 2.
Yeah.
That just kills off everyone.
And I think financial planners probably bear more of that because we're dealing with people's money, right? So there's much more emotion involved in it, as opposed to just another industry where that doesn't come into play.
How many people actually you've came across that don't think about planning for retirement?
Well, I'd probably say everybody.
Yeah.
Because not so much about not planning for retirement, but not knowing what to do to get there. And that's there's nothing wrong with that. It's like me if I have something wrong with my car. Like I had no idea about cars, but I know that to get it fixed, I'll go and see a mechanic and I'll try and find one that is recommended to me.
Yep.
So it's more, once you have that chat with clients and point out to them, look, they might have planned for a time in terms of the basics. I want to retire now or at such and such age, or I want to retire with earning this much per year. But
it's the steps getting there.
Yeah, and it's more obviously the earlier you start, the easier it is to achieve your goal. A lot of people will leave it, I'm thinking of retiring in 5 years. What can I do to get there? It's like, well, based on what your goals are, you're not going to get there. If you would have started 20 years earlier, most likely. But I think once you have that chat with client and you point out, look, this is what we can do now and in the coming years to improve your position, a lot of the time they say, oh, we should have done this earlier.
Yeah.
Hindsight is 20/20, as I say.
Andrew, thanks for joining me in this podcast today. I'm pretty sure a lot of people took in a lot of insight in the financial planning world. So just our audience will know, how can they find you and seek for your services?
Look, two ways. I'm currently in the process of updating all my social media stuff. So I can't give out details of that, like website, Instagram, Facebook, whatever. But easiest way is either to call me or email me. So my phone number is 0419 467 290. And my email address is andrew@hcafp.com.au.
Fantastic. Thank you. And thanks for joining me on this podcast.
Thanks for having me.